I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 1, 2025. I'm going to jump into the dashboards. This is a dashboard of the 6 equity indexes, 4 U.S. and 2 international. International are developed markets and emerging markets, and then finally long-term government bonds. The yellow box in the center is the rate of return for each of these indexes, the Dow, the S&P, the NASDAQ, etc. These indexes for the last week. All but one were negative, and that one was almost break even. So, and none of them were hugely negative, but slightly negative. And then year to date is in the red box, and they go all the way from emerging markets at 26% rate of return, developed markets at 22, and then to the, U.S. markets going from 16% down to 8%, and then long-term government bonds, 1%. Each of them are above their 20, 50, 100, and 200-day moving averages, as illustrated by the green dots to the far right. This is the third week in a row where we've had all green dots. The market is moving up and is moving up consistently. So, going to the sectors, when you break the S&P 500 down into its 11 major industrial sectors, they look like this. They are ordered from top to bottom, highest to lowest, in the red box, going from a 19-20% rate of return for technology all the way down to a negative 1% for healthcare. The yellow box is what happened last week, and there's 3 of those that were positive and the rest of those were negative. But they all blend together to equal, on a weighted basis, to equal the S&P 500. On the right side, that's where are they relative to their moving average, 20, 50, 100, and 200-day moving average. There are 10 of them that are negative, leaving 34 positive this week, and last week there were 35 positive. The S&P 500, this is the chart for a 3-year period of time going up. Now there are dips, as you can see a couple of them that are a little more pronounced, but other than that, for 3 years, this has been kind of on a run, and is still on a run. It dropped a little bit last week, not much. And this is the same chart on a candlestick basis, showing red candlesticks that it's usually a down week, hollow ones, usually an up week. But since the 7th of April, you can see with that on about an inch or so from the far right, it was down, and then it went up from there, and it's mostly been positive since April 7th. So here we are, 1st of October, almost 6 months, a positive return. So at some point, people are thinking this, at some point, it can't go forever. At some point, it's going to run out of steam and have some kind of a correction. But our investment approach is we follow the trend. The trend has been up. We've stayed in the best performing index for that period of time, and we don't question it. So we were still invested in the market. When you take the last part of that, not quite third, this year, from January 1 of 2025 to present, it looks like this. So you see the drop there at the early April, and then the move up from there. Again, it's been a very good run. It could keep going. We don't know. I mean, it could pull back. When we get an indication that it's too much risk has entered the market, we'll get out. Until then, we're staying in. Okay, this is a relative strength chart. NASDAQ 100 numerator, S&P 500 denominator. So when the line moves up, that's going to favor the numerator, the NASDAQ 100. When it goes down, it's going to favor the S&P 500. This is, again, in the past 6 months or so, has been generally moving in an upward direction. The S&P 500 breaks into two major components. One is growth stocks, and one is value stocks. When growth stocks go up, this relative strength chart is going to go up. The line will go up. When value is in favor, then it will go down. Value would be like, let's say Boeing or Ford or Pfizer or JP Morgan. Those are value companies. Growth companies would be like Google, Apple, Amazon, Facebook, etc. Another relative strength chart showing the S&P 500, in this case as the numerator, and small cap, Russell 2000 small cap ETF, IWM, as the denominator. So when it goes up, this favors the S&P. When it goes down, it favors small cap. I drew two lines here, one to show the longer term picture, which is the black line, black arrow, long term going up, but a shorter term for the last couple of months. I did a red arrow at the upper right showing the shorter term direction is actually in a downward direction. So we don't know if that's going to go on down further or if it's going to turn around and go back up. That's to be determined. Long-term government bond. This is excuse me just a minute. This is a 5.5-year chart showing TLT, the long-term government bond ETF, that is, from black line, generally going down. However, I took a line and I drew the red line, I drew across the bottom to say, look at this. I mean, that's a 3-year period of time. In that 3 years, the long-term government bond has gone up and down and up and down. It's gone nowhere. That shows you where it was 3 years ago, approximately where it is today. So it doesn't know if it wants to go up or wants to go down. You could make a case for either. The dollar, longer term, has been going up, as illustrated by the black arrow. However, since January, it has been going down. So it depends on what time frame you're looking at as to what you want to say about it. So positive or negative, they're both correct. Take the S&P 500, take the U.S. stock market, of which the S&P 500 is a proxy. Compare that to other countries. We could pick any number of European, Asian, even South American, Australian. We could pick any of these countries and do this. I pick on South Korea because it's a fairly smooth chart. It doesn't jump around a lot. So with South Korea, when it goes down since January 1, that means that South Korea has outperformed, their stock market has outperformed the U.S. market over that period of time to that extent. So the U.S. market has lagged nearly all markets in the world, but this being one of them. Volatility, the volatility index called the VIX, V-I-X, when it goes down, this shows that there is reduced volatility in the market. Usually that means the market is moving up. And since April 7th, you can see the arrow is moving in a downward direction. So it moved initially very quickly down, and now it's continued to go down. There appears to be stability in the equity markets at this time. Gold, look out. Gold is on a tear. It has gone up in this 3-year period of time, but more specifically in the last couple of months, look at it. It's just soaring above its moving average. I think that my opinion is that gold is manipulated somewhere in the global markets. I don't know how or who, but that's what my opinion is. But I think what's going on here, again, my opinion, is that I think there is such demand for gold right now that I think it's running away from the manipulators, the banks. And it's going over to supply and demand, which it has not been previously, in my opinion. Now, look at silver. Do you think that's going to the moon? It looks like it, but of course it's not. At some point, it will have to come back to Earth. It will have to mean revert and come back down. But right now, it just keeps on going, keeps on going. And as of today, I'm recording this on Monday, as of today, not included in this, it's up again. So I don't know what this week is going to look like, but through Friday and then again more on today, Monday, continues to climb upward. Amazing, but no other period has been like that. Maybe if you go back a long ways, you can find it, but in this period of time, none has looked like that. Bitcoin has, for about a year or so, has been kind of gone nowhere. I mean, it went up, and then since that time, it's gone up and down, kind of back where it was, started about a year ago. Okay, here's the numbers on gold and silver. The gold is closed Friday at $3,758 an ounce, spot price, up 2% over the previous week. Silver closed at $45.99, and of course today it's up again, so it's up in the 46s now, an increase of 6.9% as of last Friday over the previous Friday. Gold-silver ratio, 82-1. We were up above X number of months ago. I don't remember exactly when. Not that long ago. We were up above 100-1. And I think I commented, I certainly thought it, this is a good price to buy silver. Gold is too high at this price. It's still too high at 82-1 by historic standards. So it still makes silver a better value than gold, but that ratio is coming down some. A monster box of silver, 500 rounds of generic silver, is $23,745. Not too long ago, I think within the last year, this is about double what it was at that time. This now includes a $1.50 markup for spot, or on top of spot, for a premium. So the cost per round retail using a $1.50 markup as my number is $47.49 per ounce. This thing is moving up toward 50, and it doesn't seem to want to slow down. This is from my son Preston, who is a precious metal dealer in Tennessee, and he tells me, he said, "Dad, people are bringing in their silver and gold. They're, I'm just all day long, all I'm doing is buying." And he loves to buy. He does sell, but when he gets the opportunity to buy, he always buys, and pays a fair price for it. But when things go up this high, there are people who are looking to cash in. It could even be jewelry, it could be silverware, it could be coins, bullion, whatever. He said they're just coming in all day long. Okay, if you have questions or comments, leave them in the comment section below. Thank you for watching.